You are watching this market in real time, and what you are seeing is not a small correction, not a normal fluctuation, but a violent shift that has shaken confidence across the entire digital asset space. Just a few months ago, Bitcoin was trading above $120,000. Headlines were filled with optimism, and the narrative was simple. The cycle was unstoppable. And yet here we are, standing in a completely different reality, watching prices struggle in the 70,000 range, with fear spreading faster than any price chart can capture. If you look closely, the first signals were already there, but most people ignored them. Volume began to spike in late 2025, not in a healthy way, but in a way that often appears near distribution phases in financial history. We have seen this before, not just in crypto, but in the dot-com bubble, in the housing market before 2008, and in commodities during late cycle peaks. When volume explodes while volatility widens, it often means large players are repositioning, while smaller participants are still buying the narrative of endless growth. Then the cracks began to widen. Prices did not collapse in a single day. They eroded, month by month. Momentum weakened. October averages above 114,000 gave way to the 90,000 range. And by the end of the year, the market was already struggling to maintain upward pressure. This is how major trend reversals often begin, not with a sudden crash, but with a slow, almost invisible loss of strength. And behind the scenes, deeper forces were moving. Mining economics started to deteriorate. Energy costs remained high in many regions. Hash rate pressures intensified, and weaker miners began to capitulate. When mining difficulty drops sharply, it is not just a technical adjustment, it is a signal of stress inside the system. Historically, events like this have marked periods where the market was digesting excess leverage and unsustainable expansion. At the same time, liquidity conditions across global markets were changing. Interest rates remained elevated compared to the era of ultra-cheap money that fueled earlier crypto rallies. Capital was no longer moving as freely into high-risk assets. This is a macroeconomic reality that has shaped every major speculative cycle in modern history. From emerging markets in the 1990s to tech stocks in the early 2000s, tightening liquidity has always exposed fragile structures. And yet, here is where the story becomes more complicated. Despite the decline, institutional interest has not disappeared. Conferences are still taking place, industry leaders are still building infrastructure, and policy discussions in major economies are moving toward clearer regulatory frameworks rather than outright bans. In other words, the foundation of the ecosystem is not collapsing, even as prices fall. This contradiction is what makes this moment so difficult to interpret. On one side, price action is sending a signal of fear, exhaustion, and deleveraging. On the other side, the long-term structural narrative, adoption, infrastructure, regulatory clarity, continues to advance, quietly and steadily. Markets often reach their most confusing stages when these two forces collide. So, what are you really witnessing right now? You are not just watching a price decline. You are watching a transition phase, a moment when expectations are being reset, when speculation is being separated from sustainability, and when the market is testing how much conviction truly exists. Every major financial cycle in history has had moments like this. Moments when sentiment turned sharply, when narratives fractured, and when the crowd began to question everything it believed only weeks before. And the real question, the one that matters more than any daily chart or headline, is not whether the drop itself is dramatic. The real question is what this drop is revealing about the structure of the market, about liquidity, about psychology, and about the stage of the broader cycle we are actually in. Because once you understand that, you begin to see that movements like this are never random, never isolated, and never as simple as they first appear. What you are seeing now is not only a price movement, it is pressure building inside the machinery of the system itself. And if you listen carefully, you can almost hear the strain. Because when markets fall this way, the real story is rarely on the surface. The real story is underneath, in the costs, in the balance sheets, in the invisible forces that determine who can survive and who cannot. Look at the mining sector, because this is where the first real fractures appeared. Mining is not just a technical process, it is an industrial business. It depends on electricity prices, hardware efficiency, financing conditions, and access to capital. When Bitcoin was trading near its highs, even inefficient operations could survive. But as prices began to slide and energy costs remained elevated in many parts of the world, margins collapsed. And when margins collapse, weaker participants are forced to shut down, sell reserves, or liquidate equipment. This is exactly what began to happen. Mining difficulty dropped sharply, one of the largest declines in years. That is not a small signal. That is the system adjusting to stress. Historically, sharp difficulty drops have often appeared during moments of market cleansing, when overextended operators are pushed out and the network resets to a more sustainable equilibrium. You saw a similar pattern after China's mining ban in 2021, and even earlier in smaller cycles where hash rate contractions followed prolonged rallies. And here is the part many people misunderstand. When miners capitulate, they often sell Bitcoin to cover costs. That selling pressure does not happen all at once. It unfolds over weeks. It creates a slow grinding effect on price, a kind of steady downward gravity that wears down bullish sentiment. This is not panic selling from retail traders. This is structural selling from the supply side of the network itself. At the same time, liquidity conditions in global markets have not been favorable. Central banks around the world, even when they pause rate hikes, have not returned to the aggressive monetary expansion that fueled the great rallies of the past decade. Real interest rates remain positive in many economies, and when real yields are positive, capital has alternatives. Investors do not need to chase risk the way they did during the era of zero rates. This is a fundamental shift, and it changes the behavior of markets at every level. You can see this pattern repeated throughout financial history. In the late 1990s, technology stocks surged during a period of abundant liquidity, but once monetary conditions tightened, the weakest companies began to fail first. In the mid-2000s housing cycle, rising borrowing costs exposed fragile mortgage structures that had seemed stable only months earlier. Liquidity is the oxygen of speculative markets, and when that oxygen thins, the most leveraged parts of the system begin to suffocate. And yet, there is another layer to this story. While weaker miners are being forced out, stronger operators are expanding, acquiring cheaper hardware, negotiating better energy contracts, and preparing for the next phase of the cycle. This is how every industry consolidates under pressure. The weak exit, the strong accumulate capacity, and the structure of the market becomes more concentrated. You saw this in oil, in steel, in shipping, and now you are seeing it in digital mining infrastructure. So you are witnessing two processes happening at the same time. On the surface, the market looks fragile. Prices are volatile, sentiment is uncertain, and headlines focus on fear. But beneath the surface, the system is reorganizing itself. Hash rate stabilizes after adjustments, block times normalize, and the network continues to function exactly as designed. The protocol does not panic, it adapts. This is why moments like this feel so confusing. You are watching stress, but you are also watching resilience. You are watching capitulation, but you are also watching consolidation. These two forces exist together in every major market transition, and they create the tension that defines turning points. And what matters now is not the noise of daily candles or the emotional reactions that dominate social media. What matters is understanding that markets are living systems. They expand, they overheat, they contract, and they reset. And right now, whether people realize it or not, you are standing in the middle of one of those resets, watching the structure of the Bitcoin market reshape itself in real time. Now, there is another force you need to understand, and it is not technical, not mechanical, and not even financial in the traditional sense. It is political, psychological, and institutional all at once. Because markets do not move only on numbers, they move on expectations, on narratives, and on trust. And right now, that trust is being tested in real time. You have heard the headlines. After the 2025 election, the environment around crypto was expected to become more supportive. Many believe that a pro-crypto political climate would create a straight path upward for Bitcoin, that regulatory clarity would remove uncertainty and unlock a new wave of capital. That expectation became part of the market psychology. It was priced in long before policies were actually implemented. And this is where reality began to diverge from belief. Regulatory frameworks started to appear, but they were not simple or immediate solutions. Discussions about stablecoins, oversight structures, and financial supervision created a complex landscape rather than a clear green light. Markets do not like complexity. Markets prefer certainty, even if that certainty is restrictive. When rules are still being written, capital hesitates. You have seen this pattern before in other industries. Think back to the early days of the internet, when governments were still deciding how to regulate digital commerce. Or consider the banking reforms after the 2008 crisis, when uncertainty about capital requirements and stress testing slowed lending and investment for years. Regulation does not always destroy markets, but the period of uncertainty around regulation often suppresses momentum. And there is another layer you need to see. Institutional investors do not react the way retail traders do. They do not chase headlines or panic over daily moves. They watch policy signals, interest rate trajectories, and macroeconomic stability. When there is ambiguity about future regulation, large capital often waits. And when large capital waits, markets lose one of their most powerful sources of demand. At the same time, psychology inside the market began to shift. What had been excitement turned into hesitation. What had been confidence turned into doubt. This is what analysts sometimes call narrative exhaustion, or what some traders describe as fatigue. It happens when a story that once energized participants stops producing new catalysts. Without new catalysts, enthusiasm fades, and when enthusiasm fades, momentum weakens. You could see it in sentiment indicators, in declining trading volumes after the October peak, in the way rallies became shorter and pullbacks became deeper. These are not random fluctuations. They are signs of a market that is no longer driven by euphoria, but by caution. And yet, here is the paradox you must understand. Even as prices declined and sentiment cooled, the broader infrastructure of the industry continued to grow. Conferences remained crowded. Developers continued building. Financial institutions kept exploring custody solutions, payment integrations, and blockchain applications. The underlying engine did not stop running. This contradiction is not unusual. During the early 2000s, after the dot-com bubble burst, many internet companies failed, but the internet itself continued expanding. Infrastructure improved, broadband adoption increased, and new giants eventually emerged from the wreckage. Markets often confuse the collapse of speculation with the collapse of innovation, but the two are not the same. So what you are witnessing now is a conflict between perception and reality. Perception says the market is weakening, that confidence is fading, that uncertainty is rising. Reality says the technology continues to function, institutions continue to engage, and the regulatory environment, while complex, is gradually becoming more defined. And when these two forces collide, fear in the short term, development in the long term, you get exactly what you are seeing now: volatility, confusion, and a market searching for direction. This is the stage of a cycle where emotions become loud and clarity becomes rare, where every headline feels decisive, but none of them truly determine the outcome. And if you step back and look at it from a distance, you begin to realize that what feels chaotic in the moment is often just the slow and uneven process of a market finding its next equilibrium. Right now, what you are witnessing feels dramatic, even violent, but you need to understand something that only becomes clear when you have watched markets for many years. Every major financial cycle contains moments that feel exactly like this. Moments when confidence fractures, when headlines turn dark, when people begin to say that the trend is over, that the story is finished, that this time is different. And yet, history shows again and again that markets rarely move in straight lines, and the phases that feel like collapse are often the same phases that reset the system for the next stage. If you look back at Bitcoin's own history, you will see that drawdowns of 30, 40, even 50% have appeared multiple times within broader cycles. In 2013, in 2017, and 2021, sharp corrections erased months of gains in a matter of weeks, and each time the dominant emotion was the same: fear mixed with disbelief. People asked whether the rally had been an illusion, whether adoption had stalled, whether the market had already peaked. Those questions are not new. What is new is only the scale of the numbers on the screen. And this pattern is not limited to crypto. Look at gold in the late 1970s, when it surged and then corrected violently before continuing its move. Look at the oil market in the early 2000s, when sharp declines interrupted a long structural uptrend driven by global demand. Even equity markets, from the post-war expansions to the modern era, have gone through repeated corrections that felt catastrophic in the moment, but appeared in hindsight as necessary pauses in a larger trajectory. What you're seeing now is the market searching for equilibrium, and equilibrium in financial systems is never found quietly. It is found through volatility, through liquidation, through the removal of excess leverage and unrealistic expectations. Every speculative cycle builds layers of optimism that eventually become too heavy to sustain. When those layers break, prices fall not only because of fundamentals, but because psychology itself is being recalibrated. And yet, at the same time, there are signals that tell a more complex story. Mining difficulty stabilizing after a sharp adjustment, institutional events continuing around the world, ongoing discussions about regulation rather than prohibition. These are not signs of a system collapsing. They are signs of a system evolving, sometimes painfully, sometimes unpredictably, but still moving forward. This is why the question that dominates headlines, whether this is a massacre or an opportunity, is actually too simple. Markets are rarely defined by single labels. What looks like destruction to one participant looks like restructuring to another. What feels like panic in the short term may, in the long term, be remembered as a necessary correction that cleared the path for a more sustainable phase. But there is one thing you should understand very clearly. No one, no analyst, no institution, no government can predict with certainty what the next months will bring. Financial systems are complex, adaptive, and influenced by forces that no model can fully capture. Geopolitics, liquidity, cycles, technological shifts, and human psychology itself. Anyone who claims absolute certainty in moments like this is not describing reality. They are describing confidence, and confidence is not the same thing as truth. So, what matters now is not trying to guess the exact path of prices. What matters is recognizing where you are in the broader rhythm of markets. You are in a phase of tension, a phase where narratives are being challenged, where expectations are being rewritten, where the easy answers disappear and only the deeper patterns remain. And if you have watched enough cycles, if you have studied enough history, you begin to realize something that is both unsettling and strangely reassuring. Moments like this always feel unprecedented while they are happening, but later they are recognized as part of a pattern that has repeated for generations. And that is where we stand now, not at the end of a story, not at the beginning of a new one, but in the uncertain space between chapters where the noise is loud, the signals are mixed, and the true direction of the market is still being written in real time.